Good afternoon, everybody, and welcome to our webinar today with Carrick Wealth Zimbabwe and the RPA group. I'm joined today by a very familiar face of George Radford. Those of you who have joined us on webinars in the past will certainly have heard him present and seen his skill in that and his knowledge of the UK property market, which we'll be getting a lot of today. Just skipping through the slides. So George Radford is joining us from RPA Group, our partners in the UK. We've had a relationship with George for probably about 7 years now, or as long as Carrick has existed. We've helped many clients through Carrick with our relationship with George. And many within Zimbabwe as well. So George, thank you very, very much for your time today.
Pleasure, thank you.
Okay. All right, so today we're just to go through the agenda. We're going to be looking at the UK property investment hotspots for 2022. And perhaps before I run through the whole agenda, 2021 was a fantastic year for the UK and property market in general. So, George, before I move forward, just a bit of an update on last year. What are your thoughts and opinions?
Yeah, thank you, Andrew, and a big welcome to everyone in the beautiful country of Zimbabwe. Look forward to getting back there soon. So last year, despite some of the headwinds of the COVID, what people thought COVID would present, was an incredible year for the UK property market. 2021, we saw in excess of 10% growth across the whole of the United Kingdom, and a lot of locations outperformed that significantly. And I suppose, why did that happen? A number of reasons, really. The key one is supply and demand imbalance. So there was just over 200,000 units delivered in 2021 against the government's target of 300,000. So we're still around that sort of 100,000 unit shortfall of units per year. There's huge supply. There's a lot of cash floating around. People are looking for returns. They're not getting those returns in bank accounts. Some people maybe are disinvesting from other asset classes, getting into property, and there's a lot of institutional money chasing residential property because of the returns there. So, you know, you've got a perfect storm in terms of the supply and demand imbalance, I suppose. Also, there were challenges created by COVID in terms of construction. So that reduced the volume of units delivered in 2021 to 2020. To give you an idea, it was about 30,000 units less, which further squeezed the supply. So yeah, the supply and demand imbalance was a key driver. A lot of money chasing returns, and then, you know, the big challenge we've all got now is inflation, which is driving up building costs, and that's, as a direct result, driving up property values as well.
Yeah, and George, you bring up inflation. Yeah, I've been looking at that a lot lately, and right now on the US dollar, which Zimbabwe primarily trades in, it's sitting at 7.5%. So, you know, right now everybody thinks I've got cash in a bank account, or they've got that history and think my money's safe in cash. Well, right now it's actually the only place where you're pretty much guaranteed to lose value. And right now it's 7.5% in the space of a year. It's quite scary. It hasn't been that high since February 1982. So 4 decades since it was at that level.
Yeah, it's scary. It is 30-year high in the UK now, around 5.5%. You know, they suspect it could go up to 8%. April, May. It's a big problem for the world. How do central governments and banks control it? They increase interest rates. They can't increase interest rates significantly because that's going to strangle the global economic recovery coming out of the pandemic. So it's a really difficult balancing act for global governments now. So we'll just have to keep an eye on it and see where we go. But at the moment, it's very good for property values. So
Yeah, no, exactly. And I do think it's going to be a very interesting year in 2022 as it unfolds for the reasons that you brought up. And you know, property is arguably the ideal place to be putting one's money right now. You know, a stable asset that isn't going to be thrown by volatility brought on by rising interest rates and tension between Russia and Ukraine and everything else that's moving things along. So I think that comes into point number 4 there, and that importance of diversification and just making sure that you have a foothold in these different asset classes, which I know that we're gonna go into a little bit later. So thanks for the update on 2021, and looking forward to hearing everything on what to expect as we enter 2022. Just moving through that agenda now. So how can Zimbabweans invest in UK property? Well, we've been doing it for many years now. As I say, we've been dealing with George for since Carrick's inception, and he's been dealing in Africa long before that as well. So Zimbabwe is a hotspot for international property. We do by nature like property as an asset class. And it's a lot easier than one might think, which we're obviously going to get into. And it all comes down to having the right partners on the ground in the UK, which we have through George, and of course, highly beneficial being able to walk into an office in Sablevy's village in Harare, sit down in front of a Carrick advisor and a real person who's going to take all of the heavy lifting off of you and help from that perspective. Similarly so on the mortgages, which we're going to be chatting about today as well. It's very hard for us as Zimbabweans when, for a majority of us, we can't get a mortgage in our own country, but all of a sudden we can get one in the UK. So it almost sounds a bit too good to be true, but we know that it is, as we've achieved that for many clients already. Importance of diversification we've pretty much gone through, and really looking forward to seeing the developments that you're going to showcase for us today in both London and Birmingham. So George, at that, over to you.
Brilliant. Thank you for that. So just we've reflected on what happened last year in terms of what's going to happen this year in terms of the UK property market. More of the same is my sort of view on it. Are we going to get 10% growth in 2022 as we did last year? Potentially. It might taper off slightly and be a bit less than that, but as things currently stand, you know, the growth up until the end of January, to give you an idea, year on year, so for the previous 12 months up to the end of Jan, was 11% for the UK market. The average price of UK property now is over £250,000. So it is continuing to go up, and with this dynamic of a massive sort of intrinsic shortage, supply shortage on residential property, increased demand, predominantly driven by domestic demand, not international demand, and the international demand is coming back now significantly. Hasn't been there as strongly as it was pre-COVID, but it's really coming back now. So you've got a huge amount of money and a huge amount of demand chasing a lesser amount of stock, with inflation driving up construction costs, which developers invariably in timing have to pass on to consumers by way of increasing prices. So I think 2022 will be, if not as good, you know, sort of not far off the previous year. And we can look at some of the hotspots that we're identifying in the likes of Greater London. We're also very active in southeast of England, commuter London, and then regional UK cities, namely Birmingham. So hopefully that sort of high-level insight to what's going on in the market. Just having a quick look at the sort of the process for Zimbabweans being able to invest into the UK property market. I think it's probably best answered by looking at the services that we provide and linking it into that. So, I mean, first and foremost, there's no restrictions for Zimbabwean-based clients, of which I have many and you have many, Andrew, and investing into the UK property market. We've done so very successfully many times before, and we continue to do that. The transactional process can be handled remotely from Zimbabwe. That's often a point I forget to comment on, but you don't need to fly to the UK to undertake this transaction. It can all be done remotely from your home or Andrew's office. So yeah, there's absolutely no restrictions, and our job in this process, the RPA group and Carrick Property, Carrick Wealth, is very much just to facilitate the process and to make sure the transaction is handled as effectively and as efficiently as possible, to make sure your customer journey is as smooth as possible, and ultimately that the property that you're acquiring delivers the strongest return on equity, because that's what we're here to achieve. So in terms of achieving that, fundamentally with any investment, research and due diligence at the front end, that underpins everything. Without that, there's no point investing, because it wouldn't be safe, and we can't be sure of its performance. So myself and my team undertake all of that research and due diligence at the front end to make sure we're onboarding projects, developments that are going to outperform, with good developers that are well capitalized with a very strong track record, and when we present developments to our clients, we know that they're very robust and they will deliver. Then in terms of the investment advisory process, this is very much undertaken with your Carrick Wealth advisor, and this is really just understanding your requirements and your financial circumstances, and giving you some tailored advice on what property solutions are going to best meet your investment needs. So that's looking at budget, your availability of mortgage financing, the time frames you're working towards, and so on and so forth. On the conveyancing, sorry, Andrew.
Sorry, George, just sorry to interrupt you there, but just whilst we're on the investment advice, just to let everybody know that we're actually going to jump into a live example at the end of the webinar, where we're going to run through the numbers and the returns on investment for a live unit, so that everybody can get an idea from a financial perspective and a financial advisory perspective. So make sure that we all hang around to the end so that we can go through that.
Yeah, absolutely. On the conveyancing side, quite simply, the legal process, we facilitate that. We work with national UK law firms who act on your behalf, so they protect your interest as the investor, as the purchaser. We recommend them because we know they're a safe pair of hands and that they're efficient. So, but we obviously guide clients through that process. On the mortgage side, again, as Andrew mentioned, we facilitate that either directly with lenders or by a network of mortgage brokers, to ensure that you get access to the best product in the market. We'll come on to mortgages in a second. On the lettings and management side, we've got in-house lettings and management business to ensure that the client's portfolio, when it completes, that 1 or 2 bed property in Birmingham, as an example, is managed in the most effective way, doing the handover, the snagging, securing the tenant, collecting your rent, and just making sure that everything is in place excuse me, for your investment, to make sure it runs as smoothly as possible. And then when you wish to exit and liquidate the asset, then we can facilitate that as well by helping you to resell back into the secondary market. So hopefully that covers the key points. Any questions, then of course we can take those as we go. I think you can submit your questions in the chat box, which you should see on the right hand side, I believe, of your screen. Just in terms of the RPA group and the background, so I'm one of the founders of the business, Richard Bradstock based in the Middle East, and Giles Ledbetter based here in the UK. So we've all got around 20 years of property investment experience, so very well versed on this. Offices in South Africa, the UK, the Middle East, Asia. We also have a global partnership with One Global Property Services, who just broaden our global network, but also very importantly give us fantastic access to some institutional sort of developers, such as Barratt London, as an example, who are FTSE 100 developers. So we're very proud of our partnership with One Global as well. I suppose the point being that we've got resources on the ground to assist clients in all over the world. and myself being based here in the UK, pretty miserable day today, I might add. It just adds a huge amount of value to the clients, knowing that we're very, very close and at the forefront of bringing these projects on, and very close to developers to make sure that transactions are handled properly. So going on to the mortgage side of things, then, I mean, there's no point trying to brush over the fact that it is challenging to get a mortgage, more challenging when we're based in Africa. I mean, naturally, if you're based in the UK, it's a bit easier. But we undertake this process very stringently and closely with our clients to ensure that they do have access to mortgage financing. And that's really achieved fundamentally by having a very detailed and insightful discussion with clients at the outset to understand your financial circumstances, and then present the mortgage options and look at the mortgage options available to you before you embark on your investment journey. Number of reasons: one, to protect you, obviously, but two, to understand what is and is not possible for you in terms of mortgages, because that will dictate the investment strategy in terms of the budget and the most suitable options that we should be presenting to you. In terms of the process, quite simply, it's pre-screening up front. Who can we help? We can help local Zimbabweans. We can help expats based in Zimbabwe. You don't need to be British to get a UK mortgage. Employed and self-employed. Employed is easier than self-employed for obvious reasons. It's at lower risk. And we can help clients looking for buy-to-let investment mortgages, so investment mortgages, which is 95% of what we do, but also clients looking for primary residential mortgages, their homes essentially. In terms of the products available in the UK, you've got two different types of products. You've got a repayment mortgage, i.e. it's paid off over the lifetime of the loan, or you've got interest only, where the principal remains the same and you just pay off the interest every month. Interest only is better for yield. Some clients like the flexibility and the increased positive cash flow that creates on a month-to-month basis. Other clients like to pay it off over the lifetime of the loan, and we can always look at both options available. In terms of rates, looking around 4%. You can get fixed rates, so locked in typically for 2 to 5 years, or we can have variable rates, so it just tracks LIBOR, which is obviously directly dictated by the Bank of England base rate, which is currently at 0.5%. In terms of the loan to values, so the amount of mortgages that clients can acquire, for Zimbabwean-based clients, so the worst case scenario would be looking at around a 50%, 50 mortgage. Interest rates of 4.5%, 5%, let's say, at that lower loan to value. Best case scenario, we'd be looking at around 65% loan to value, and interest rates, 4%, potentially a smidge less than that, depending on the lender. Andrew, anything you'd like to add on that? I know you work closely with the likes of Stanbic, Standard Bank on some lending.
Yeah, I think on that point, just to give everybody an indication, the general rule of thumb that we've found when previously arranging mortgages for our clients is that anything valued below £300,000, you're probably going to get a 50% loan to value. Anything valued in excess of £300,000, you're probably going to get a 65% loan to value at a better rate. So that's been our experience there. And George, just one question before you move on to the qualification and the process. When it comes to repayment mortgages and interest-only mortgages, if you were to weigh up as a percentage of what people tend to opt for, which is the favored route, and by how much?
That's a good question. More people at the moment go for interest only just because they get a better yield, and then you can periodically pay down, obviously depending on the terms of the loan, because you have early redemption penalties, but you can pay down the loan over the lifetime of the loan, sort of incrementally as you have positive cash flow, or maybe you have additional income coming in from employment. You can then slowly but surely pay off the loan. So people don't usually take on an interest-only mortgage on the basis that they're never going to pay off the mortgage. It just helps with cash flow and gives you a bit more flexibility on as and when you wish to pay down some of the loan, as opposed to every month having the heavier loan payment because you're paying off the principal, obviously. I think sometimes older clients, if they're looking at it as sort of part of their retirement planning, maybe they want a bit more certainty that when they get to 60 or 65 that the loan is paid off in full. They might opt for a repayment mortgage sometimes, but it really depends on the individual client. But at the moment, yeah, I would say more people go interest only.
Okay, perfect. Thank you very much. Now, I have received a couple of questions. I don't know if you just want to finish the slide first, and then I'll pose those questions to you.
Yeah, pretty much done. I mean, look, there's nothing set in stone, but typically minimum income, let's say £50,000, sort of gross income gives us, a reasonable amount to work with in terms of getting access to some different lenders. And as I mentioned, it's all pre-qualified upfront by working with Andrew and the team.
Perfect. Thanks. So I'll just run through these questions now. There's about 3 of them. So firstly, we've talked about the property market in the UK as a whole. I've got a question here specifically on Manchester, and if you have any insight on that in terms of what's happened up in the north, the northern parts in the last couple of years.
Yeah, I mean, Manchester, is now one of the standout cities in the UK. So, it's experienced very, very strong growth over the last 5-10 years. My view on Manchester overall is becoming expensive. It's really difficult to extract value, certainly in central Manchester. There is value to be had, but it's just quite difficult when you're looking at stuff that's sort of 500 a square foot plus, where going back sort of 5-6 years ago, that was £300 a square foot, to give you an idea. And there is quite a heavy supply side in Manchester. So I favour sort of pockets of value in and around the central Manchester market, because I see better value and better yield profile in those locations. But look, it's a great city. It's a world city. It's a great place to go. It's got a huge financial services industry now, and it's gone from being sort of the poorer cousin to London to being a fantastic city in its own right. So I think it's got a strong outlook still. It's often voted one of the best places to live in the UK in terms of cities. So yeah, I think it will continue to do well. But my only caveat would be, if you do invest in Manchester, you've got to be very careful that you're getting good value, because the prices are very high there now.
Okay, thank you. And we've got a question here: Zimbabwean living in the USA. No issues from that perspective?
No, wonderful. One of the old US dollar earners. We like that, don't we, Andrew? So yeah, USD is obviously favourable. So no issues at all.
Okay. And then on the minimum annual income of 50,000, if you have a joint application, do they take into account having multiple earners within that?
They do, but the threshold can go up. So I think with regard to that client's specific scenario, it'd be a matter of having a more detailed conversation and sort of understanding how the income's derived and so on and so forth, and what the total income is, and presenting that to some brokers and seeing what options exist out there.
Okay. Perfect, thank you. There is one more question, and then I think if anything else comes through, we'll tackle it at the end. So this is a longer one. Zimbabwean studying in the UK, interested in buying a property within the UK. How do we go about it? are we likely to get a better rate for a Zimbabwean resident in the UK? Are we likely to get better lending in terms of the loan to value? Can they borrow more against it if they are younger and getting started out?
So yes, basically is the answer to all your questions you've asked there. But it comes back to income, employment status. If you're studying, it's unlikely you're going to qualify for income. So, but if you, in terms of being a UK resident, absolutely, that's massively favourable for mortgage applications. But the financials obviously need to be there as well. So again, maybe best to follow up and have a discussion directly with that client.
Perfect. Okay, thank you very much, George.
Pleasure. I'm just mindful of time, so I'll sort of whiz through some of this stuff. And of course, we'll share a copy of the recording with everyone and the slides. So most of this is quite obvious, the benefits of international property investment, long-term wealth generation. We know if you buy well and you hold in the UK, you make money. Hard currency rental income, obviously massively favourable for a lot of our clients based in sort of in the Africa region who are looking for stable GBP income. Leveraging, we've touched upon. Often I find my Zimbabwean clients, South African clients, sub-Saharan African clients, love the tangibility of property and the security that comes with that. Diversification we've spoken about, and I'll come on to later. Currency exposure, obviously. Succession and retirement planning is a bigger one now than it has been in the past. A lot of clients looking at buying property strategically to form part of their retirement income, and also succession planning for their children. And children's education is bigger than ever now. You know, not necessarily looking to buy a property for the child to live in, but investing in property in a smart way that's going to generate good returns over a 5-10 year hold, and then using those funds to partly fund or fully fund for a child's education down the line. Essentially making profit from good property investment, and then, you know, using those funds to pay for little Timmy to go to university. So why the UK? Most of this, again, quite obvious. Robust economy, 5th biggest economy in the world. The interest rate environment, favourable exchange rate, especially if you hold USD. Sterling is still relatively weak. Safe and sound legal system, supply issues we've spoken about. Education system, it's best in the world, arguably, along with the United States. Certainly for international students, it's favoured. The central location of the UK means for business, you know, it's hugely popular, and London really is you know, one of the most significant cities in the world. Ease of access to the UK, we've got a fantastic airport network, infrastructure, albeit trains can sometimes be a bit late or cancelled, but there's a lot going on in terms of Crossrail, HS2, new train lines in London to Birmingham, which we'll elaborate on. We've got a very strong and steady population growth, very strong rental demand, which underpins sound property investments, and the UK, as we're probably no doubt aware, is one of the key sort of technology startup hubs in the world. So there's a huge amount more that I could add to that, but ultimately just conscious of time. But those are some of the fundamentals, I suppose, that underpin the UK and why clients like it. Just looking at Birmingham, why do we like Birmingham? You know, it's one of the most important cities in the United Kingdom. It's the 2nd biggest city in the UK after London. It's got a very young population, one of the youngest populations in Europe in terms of in terms of cities. They've got a fantastic university set up there, you know, almost 100,000 students. Premier League football teams, massive exhibition centre, the biggest in the UK, fantastic retail facilities, more Michelin stars than anywhere in the UK outside of London. You know, the list goes on in terms of why Birmingham. You've got a huge amount of international companies now either locating there or opening regional headquarters in Birmingham, because it's a great place to be. It's cheaper in terms of cost of labour, and it's cheaper in terms of office rents than the likes of central London. In terms of the property perspective, we're looking sort of 24–25% growth over the next 5 years for the Birmingham property market. Very strong rental appreciation, 3.5% this year, 2022, and there's still a massive shortfall of new homes in Birmingham between that over the next sort of 10+ years. So strong shortfall, very high demand. Will inevitably result in a decent capital appreciation and rental appreciation over the next few years. Just going on to the next slide. One of the key drivers is infrastructure in any property investment. HS2, so much to talk about, so little time to talk about it. So what it's fundamentally going to do is link London to Birmingham and cut the journey time in half, down to 45 minutes from 82 minutes. So, if you think about commuting from London or having a regional office in Birmingham with the headquarters in London, being able to get from one to the other in 40+ minutes is remarkable. It's also headquartered in Birmingham, HS2, huge job creation, tens of thousands of jobs being created off the back of it, huge regeneration for the city of Birmingham. And it's also driving the growth of Birmingham Airport, because naturally, if the city's better connected and you get to the airport easier, then people come from further afield to use the airport. So, there's so much exciting stuff going on in Birmingham as a city, including this development here, the Scholars Quarter, which I'm delighted to present today. In my view, hands down, the best new development in Birmingham. Been to the site many a time. I'll show you exactly where it's located in a second, but we're working with King's Crescent Homes here, a fantastic medium-sized UK developer, award-winning developer, who we've worked with many times before. We know they deliver a fantastic product, and we're absolutely delighted to be partnering with them again on this opportunity. The investment fundamentals, we're building 100 units here. It's just under 2 years off plan. It completes at the end of next year. A mixture of 1 and 2 bed units. The 1 bed starting from just under £200,000, the 2 beds from around £281,000. The other key points to point out here: 10-year building warranty, a decent yield profile. We're looking at sort of 5% plus on the rental yields. Some of the units come with outdoor space, but it's built around a central courtyard area, so it's very sympathetically designed and cleverly designed to ensure that all units have at least close access to outdoor space if they don't benefit from a balcony or a terrace. In terms of how this works from an investment perspective, to secure a unit, it's an initial £2,000 reservation fee to reserve a unit. Then on the exchange of contracts, this is usually sort of four weeks post the reservation. Once the legal documents have been completed, you pay a 20% deposit, and then the balance is not payable until completion at the end of next year. So let's say, almost 24 months from now. From a budget perspective, how does that look? Let's say a 1 bed, £200,000. Your initial equity is £40,000, and your equity on completion would be £60,000, and then you get a mortgage of 50%, let's say £100,000, and there'll be some additional cost. If we can leverage higher for you as a client, then of course we will, and that will reduce your equity requirement. But ultimately, why these investments work very well for our clients is that with fantastic developers, it's a brand new development, and the payment terms are spread out as well. So that really does help from a cash flow perspective. Andrew, anything you want to add on that before I skip on?
Not at this point. No, happy to move forward. Thanks, George.
Okay, just mindful of time, sorry. So in terms of where the development's located, here is the development site here. Some of you may have been familiar with the Copperworks, which was phase 1 essentially of this development site with the same developer, King's Crescent Homes. That's just completing now. That's located here where I'm circling, and then this adjoining site here is Scholars Quarter. This is the city centre. You can walk there in 10 minutes from the property. You've got Paradise Circus here, £600 million regeneration project on the doorstep, and this whole area here is the Jewellery Quarter. The heritage part of Birmingham, which is the best place to live in the city, in short. So just, you can see this is from the top of the development side. Beautiful, beautifully designed building, and it's set around a number of internal courtyards like this. So as I mentioned, a number of the units have terraces or balconies, but there's several courtyards that the development is set around, which is brilliant in terms of the units having, being very bright, airy and spacious. So that's Birmingham. Apologies for my whirlwind tour, but I don't want to go on too much more than needed. We're now going to look at London, Bookbinder Point, fantastic new development, which we're really excited to launch today. London, hasn't really fared particularly well in the last 5 years. But its outlook is very strong, which we'll have a look at in a second. Acton, West London, now is becoming a very, very sought after part of West London because of its proximity into the West End and the city, but also its ease of getting out of London, and the beautiful sort of facilities, Kew Gardens, Gunnersbury Park, Richmond, which are really on the doorstep of this location. So it is fast becoming a prime location. Bookbinders, the new development is located here, very short walk to Acton Town Station, and Acton Town Station is a 6-minute walk from the property. And once you get on the tube at Acton Town, you can be in Chiswick Park in 2 minutes, but you can be in the West End, Paddington, 15 minutes. So fantastic connectivity, and the new Crossrail line is also coming to Acton. And that just opens up the whole of London and beyond in terms of additional transport infrastructure. So that's due to open this year, the new Crossrail station. In terms of the development then, the fundamentals, it's 98 units in total. There's a communal roof garden as well for all residents. All units have balconies. Its price is starting here, 1 bed's at 460. There's a 999-year leasehold, so it's a virtual freehold. Decent yield profile for London. The property is over 2 years off plan, so it's due to complete in Q1 2024. The payment terms are a 10% deposit on exchange, and then nothing payable for 2 years on completion. So in terms of value and quality of development, this is a fantastic opportunity for clients who are looking maybe at a slightly higher budget and looking to get exposure to the fringe of prime central London. A few other key points on the development. So Vision Develop, London specialist developer, working in partnership with Hurlington Capital. So really excited to be working with these guys. We know they'll deliver a fantastic product. As I mentioned, 98 apartments, 1 and 2 bed units. 1 bed's 460, 2 beds just under 600. Good yield profile, as I mentioned, and the payment terms are 10% on the exchange and the balance on completion. So albeit this will require a higher amount of overall equity in, as Andrew mentioned earlier, we will be able to access greater loan facilities for this type of product because it opens up private banks. So you can get a 65% mortgage on this, as an example, which would give you a total equity requirement with cost of around just over £200,000. But your initial equity or deposit payable is not actually much more than Scholars Quarter, because it's only 10% instead of 20%. So, on a 1 bed now, you're looking at paying 10%, £46,000 as an example, plus a bit of additional cost, and then not doing anything for a couple of years. So, Andrew, I know you're going to show the cash flow a bit later, and we can sort of look at how those numbers sort of follow through onto a cash flow. Let me just go to the next slide. Bear with me 1 second, slight delay. So here we are. Education, I mentioned earlier, is massive. On the doorstep, 30 minutes from Acton, University West of London, UCL, King's College, LSE, London School of Economics, and Imperial College London. So, some of the finest universities in the world within 30 minutes of the property. So that's a massive draw card for investors, but also for tenant profile. who want to have access to those universities. Also, in terms of retail facilities, we all know Westfield shopping centres. There's one on the doorstep. So anyone who likes going to big shopping malls, you've got one there. And then Kew Gardens, one of the finest gardens in the world, is just down the road. So I think they've got more seeds there than anywhere else in the world. They go on sort of program about it. Anyway, we digress. Got little missions to the rainforest and bring back all these seeds and store them for the future, when hopefully the world is not hopefully in a better place by then. Anyway, last 5 years performance. Let's have a quick look. Acton, 28% was the performance of the property market over the last 5 years, which is better than the southeast of England as a whole, but more importantly, it outperformed London as a whole. I mentioned earlier that London has been quite slow over the last 5 years. Certainly prime fell off a lot sort of pre-Brexit, but the outlook, as we'll see now, is pretty strong. But ultimately what I'm trying to show here is, despite London not performing overly well, Acton did perform very well over the last 5 years. So it's about finding that pocket of value in an area of higher growth. What's happening the next 5 years? Greater London, good outlook for this year. London's just been highlighted by PwC as the #1 city in Europe for investment prospects for 2022, and there's a whole host of other exciting accolades that London has behind it. So over the next 5 years, we're looking at sort of 25% growth there or thereabouts, 4.7% growth a year for Greater London. Prime London looking around sort of 4% per annum, 20% over the next 5 years. So London is back, in short, and we're really excited to be focusing on this opportunity in Acton. And then you can see on this side, when you get the slides, there's really positive rental escalation as well forecasted over the next 5 years for London and prime central London. Andrew, I think this is the point at which I pass to you to talk over the cash flow, and then we can deal with any other questions thereafter.
Perfect, thank you. And yeah, we have received a couple of questions whilst going through that. So we'll do all the questions as soon as I've gone through the cash flow. Like George, I'm also mindful of time, so I'm going to go through this relatively quickly. What I will say is that if anybody wants a specific cash flow, just put in the chat box, yes, 1 bed, or yes, 2 bed, and then we'll make sure that one of the guys from the team sends something through to you during the course of the day tomorrow. And on the same token, if you would actually prefer just to set up a sit down with George and your advisor, then just put yes, meeting, and then we'll make a plan to get in touch with you during the course of tomorrow as well. Okay. So running through this, when it comes to an investment perspective and understanding the financial background, the return on investment, does it make sense for me? We'll always go into a cash flow illustration, looking at where we are today, what do we need now, and what's that going to get me in the future. So if I start from the left-hand side, and hopefully everybody can see the little hand as I move my mouse over that, from the deposit structure. So we are doing this based on Scholars Quarter, 1 bed apartment, £220,000 in Birmingham. So the structure and the process: reservation fee £2,000, cash deposit then is 20%. So 20% of the purchase price is then paid, and the balance is only then due on completion. On this, we're working on a 50% mortgage summary, so 110,000 borrowed. And reason for that, as I mentioned earlier, anything under £300,000, it's best to plan based on 50%. And if you get 65 or 70, then all the better. But history would dictate anything under £300,000, you're probably going to get a 50% loan to value, and the interest rates would be at 4 to 5%. We're doing this on a worst case at 5%. So the mortgage summary there as well. So we then just summarize how much is due, and there are additional purchase costs associated when purchasing a property. So the solicitor's fees, for example, who are going to handle that exchange of contracts. So once you've decided you're going to go ahead, you put down your £2,000, you've got about a 30-day lead time with the solicitors to act on your behalf with the sellers, do the exchange of contracts. And at that point, once everybody's happy, then it's time for the 20% down payment to go in there. And then you're pretty much done, and you wait until 6 months prior to completion. And at that point, you would then go through the application process for the mortgage. You would then pay on completion the balance that you owe, which in this case is 66,000, plus a couple of additional expenses. So the furniture pack, for example, if you want it fully furnished, the stamp duty, which is really the chunky one, at about 12,000. But what we try to achieve from these cash flows is to give you as accurate as possible what your total outlay would be and what your future returns would be. So it's a £220,000 property. With the mortgage, we expect that the total outlay would be 133,000, which would be split over that payment schedule. On the right-hand side, we've then just got the cash flow projections. So a basic profit and loss. What's my income? What expenses do I need to pay on a monthly basis? So in this case, it's got about a 5% yield, bringing 910,000, £910 on a monthly basis, less your expenses, your service charges, your ground rent, so your levies essentially, your lettings and management costs. Somebody's going to take care of all that for you. You don't want to be sitting in Zimbabwe dealing with a tenant who's complaining about a broken geyser or smashed windows or whatever it may be. Somebody's going to take care of that on the ground for you, so it's fully hands off. Okay, and then that gives us a net income position being that 3.9% after those expenses. Pay off your interest on your mortgage, and there's a little bit left over, which you can spend or you can save towards the principal. In this case, it's an interest-only mortgage, and then chip away at that further down the line. And then lastly, bottom right-hand corner, what's the return on investment look like? Essentially, you've got your growth on your rental income. It's a bit of a double-edged sword. It's great because you're getting your rental income, but you're also getting that capital appreciation. So your capital growth over time. What do we predict over a 5-year period, and what do we predict over a 10-year period? So in this case, over 10 years, we expect the value of this property to have increased by £90,000, and I'd say that that's a relatively conservative assumption. I don't know if you'd agree with me on that, George. Yeah. But 220 increased by the 90, and of course rental yields going up as well, for a total return on equity of 35% and 81% respectively for years 5 and years 10 into the future. Okay. All right. So if we can just ask any questions as we'd like to, I think we'll just head straight onto Q&A. We have received a couple. George, is there anything you'd like me to add, or that you'd like? No, not at
all. Yeah, I know we've gone on quite long, but hopefully it's been informative and useful. These are 2 opportunities that we have, probably worth clarifying. We have many other opportunities, and you know, as we have one-to-one consultations and have a better understanding of clients' positions and requirements, then it may be that there are other recommendations that we make to best suit their investment needs. So yeah, probably just want to be useful to clarify that. Perfect.
Okay, well, talking of other opportunities, somebody's asked here about Cambridge as a location. I don't know if we have anything up and coming in Cambridge during the course of the year, but your view on that as a destination?
Yeah, I mean, Cambridge, obviously a beautiful city. I'm based in Winchester, you know, similar sort of cathedral city, obviously not such a great university city in Winchester. But all of these home county cathedral cities are extortionate now. It is impossible to get property within those markets, and it's certainly near on impossible to get any value. You know, to try and secure properties on the open market, i.e. people selling secondary stock, it is near on impossible. There's so much demand from the domestic market that for international clients, just being realistic, to be able to compete and acquire property in those markets, that's whether you can afford it in those markets, is near on impossible, because you've got a whole list of local domestic buyers based here with UK credit footprints who've sold their property just waiting to pounce on the next opportunity that comes in Cambridge or Oxford, you know, or St Albans or wherever it may be. But these cathedral cities, they're amazing on one hand, and they're absolutely booming from a growth perspective, but it's just impossible to get stock. We've looked at developments in all of them, but it just doesn't represent value for money in our view, and that's if you can even get the stock.
All right, perfect, thank you. And a question going on the Acton property, distance from Acton to Stamford Bridge.
Good question. Don't know if I can answer that as a Man United fan. But yeah, you can get into Chelsea very easily. You can get a bus, or you can jump on the tube, go to Paddington, and then change there and go into Chelsea. So if you're talking about public transport, 25 minutes. Taxi, you can probably do it in 20 minutes on a good day. So yeah, not far away.
And okay, so moving on back on the mortgages again. So we've got a student who's logged in here and asking, is she likely to get any options from a mortgage perspective as a student, perhaps not with a stable income and being there on a visa? What are your thoughts on that?
Unfortunately, very unlikely. Just to be honest.
Okay. And Airbnb out of these properties, what's the stance on that?
It's a very popular question I get asked, not just Airbnb, short-term lets. The concept is sound, unless you're based here and you've got a property specifically set up to squeeze the asset and sweat it and manage it tightly. Doing Airbnb, if it's allowed within that building, then it's a headache, and it's pretty unrealistic. Or most new build developments now, most developments, private developments, the ground lease does not allow for short-term lets or Airbnb. We do have one opportunity that does lend itself to that potentially, but naturally, as you know, fellow residents, it's not popular because security issues, noise pollution, and often clients, you know, they come into these discussions and they want to acquire an asset in the UK that maybe lends itself to them using from time to time when they're in the UK, and then they can do Airbnb outside of that. The concept generally is quite compelling, but the execution of that is quite often disappointing or not possible. So yeah, it's quite a challenging one to actually implement, certainly for a lot of new build developments now, because you know the ground lease just doesn't allow it, the covenants don't allow it.
Perfect. Thank you. Okay, and then we've got, can we share the numbers for repayment? So I think on the cash flow perspectives, please, if you do want us to firstly send through a cash flow, just request it in the chat box, and we'll make sure that we send one through. And then in terms of delving any deeper numbers, I think best route forward would be just to request a follow up with George and myself, or your advisor within Carrick, and then take it from there. George, question for you. This one's relating to Europe and specifically the Netherlands. So this individual has a son who studies there. Do you have any projects, either now or upcoming in the future, that one can invest into within Europe, and in this case specifically Netherlands?
Yeah, I mean, great place, obviously. The whole of Europe has been booming. I mean, most of the tier one economies across the world, from a property perspective, have been booming for the same reason: lack of supply, huge demand, inflation, cost of building materials. And the Netherlands is, in exactly the same boat. The market has performed incredibly well. It's become very expensive now. I personally feel it's quite difficult to generate value there, and it's not an area that we would be able to assist clients, unfortunately, at this stage. But yeah, it is a strong market, but it's a slightly more difficult one to navigate than the United Kingdom.
Okay, thank you very much. Okay, are we going to share the presentation? Yes, everybody will receive a recording of this. I would say within the next 24 hours, certainly. Just keep an eye on emails. You'll be able to watch it back, zoom into any parts you may have missed, and then of course, if anybody needs a follow-up, just let us know, and we can pencil things in during the course of next week, whilst it's all still fresh in our minds. I don't see any further questions on my side at the moment. If I have missed anybody, I do apologize, and we will pick up on them if anything does come through. But if there's anything immediately, please do post it. Again, if you want us to send through a cash flow tomorrow, just say 1 bed or 2 bed in the comments, and we'll make sure that you get that sent through. If you know that you want a meeting, if you want to learn a bit more from George and your advisor, again, let us know in the comments, and we'll make sure that we give you a call tomorrow to set that up. But otherwise, George, I think that's about it. So in closing from me, thank you very much. I don't know if there's anything that you need to add at this stage.
No, thank you, Andrew, to you and the Carrick team, and thank you, more importantly, to everyone that attended, and all the very best to everyone in Zimbabwe and across beautiful Africa. So yeah, look forward to being in touch soon.
Perfect. Thank you so much. Thanks, George. Thank you, everybody. Have a great day further.
Bye.